Welcome, welcome to you. This is an educational video from CL&I, which is continuous learning and improvement. Today, let's understand some basic fundamentals about loans. What are loans? Loan is nothing but borrowings, repayable after a certain period with interest. So, why are loans required? Basically, loans are an essential instrument for businesses to purchase assets, use it for regular operations, or use it for business expansion. Okay, what is that important point to be noted? Loans create a financial burden or obligation for the borrower. That is an important thing to be noted. Okay, let's move on. Why are loans required? What are the benefits of taking a loan? See, basically, loan actually provides an immediate capital for business growth. So, let's say a businessman has a plan to expand his business or grow his business, but he doesn't have money, he doesn't have capital. So, he can easily borrow money and then use it for his business growth. Another thing is, so there are two options to expand your business. One is providing ownership, ownership to other by parting your equity, or borrowing money without any dilution of control. So, loan is nothing but you're not diluting your equity, diluting your ownership, but just borrowing money for a fixed period to be repaid with interest. So, another key factor is whatever interest you pay on loans is tax deductible. So, it is an expense, a load for calculating your net taxable profit. And another important thing is if you borrow and repay within that stipulated time, within that agreed time, then you're improving your credit worthiness. Okay, what are the downsides of borrowings or downsides or risks to borrow? So, one important factor is irrespective of how your business is performing, once you borrow, that has to be repaid, irrespective whether you are doing very good in your business, you have a substantial profit, or you have a loss, whatever it is. If you borrow money, you have to repay it and with interest. So that is one of the risk of borrowing. The other risk is, or the other drawback, you can call it as interest cost. So once you borrow money, you have to pay interest also. So that interest is increasing your cost of business. So that is another drawback. And another risk factor here is basically it will definitely create cash flow issues, especially when the business is not doing good and when certain external factors is hurting your business. The borrower has to repay money as agreed, irrespective of how good his business is running, how good his cash flow is. So that's a risk factor to be considered. And borrowing is not easy. It requires collateral and some restrictive covenants to be covered. So a loan giver or a lender will surely check the credentials of the borrower, will often ask for collaterals, and will have a watertight agreement to be signed before availing a loan. So that's another drawback for borrowing. So I'm just giving you a simple calculation of loan and the repayment. Okay, let's say you want to borrow a loan of around 10 lakh rupees and the interest rate is 10% per annum, and you have borrowed for 5 years. So, and the agreement, the lender has asked you to repay over a period of 5 years on a equated monthly installment, that is the EMI scheme. So you end up paying around 21,247 as a monthly EMI, and the total amount you end up paying is about 12,74,823. So the interest cost for 5 years is around 2,74,823. So if you look at the uh, graph there, so year one, year two until year five, so your interest will be higher in the first year and gradually your interest will come down. Whereas your principal will be lower in the first year and gradually principal will increase. So technically, the EMI scheme, what happens is the lender makes sure that he gets the interest upfront in the early years, whereas the principal he gets it in the over a period of 5 years at a gradual increasing phase. Whereas interest is very high in the first year and gradually it reduces in the last year. So this is something which is crucial and which is something one has to be aware of when you are borrowing. So this is basically some real applications on borrowings. Why would businesses borrow? So for example, manufacturing unit, they would borrow money if basically something called as term loan to purchase some high-end machinery or machinery which would help them in their manufacturing process. Retail businesses normally borrow working capital loans to have some inventory. So that would be like a overdraft facility or a small cash credit facility. Whereas startups, they take loans primarily for funding their initial phase of expenses like paying salaries, that is manpower cost, or incurring expenses on marketing, like creating awareness about their product or about their service. And MSME, that is the small units, micro, small and medium enterprises, they borrow basically for expansion, any small expansion, business expansion, making sure that they don't dilute any equity. Okay, what are the key takeaways? Just a conclusion. So basically, loans are effective when matched with stable cash flows, and over borrowing increases your financial and solvency risk, and prudent loan usage supports sustainable business growth. So, at the end of the day, borrowings or loans have to be associated with the need. If you don't have any need, or you can manage with your own capital, sufficient capital, or with your own reserves, you can do it instead of going for a borrowing. But if you want to expand your business, if you want to grow your business, then don't think twice or shy away from borrowings. Borrowing is an essential tool to grow your business. This is an example of loan versus equity funding. So, if you have an investment plan or a project where you need to invest of around 10 lakh rupees, you have two options. One is either you go for borrowing or you go for own capital. So if you go for a borrowing, let's say you go for a borrowing of 5 lakh rupee and own capital of 5 lakh rupee, the EBIT of 2 lakh rupee and after interest of 1 lakh rupee gives you a 20% return on your capital invested of 5 lakh rupee. Whereas let's say you have not borrowed anything, but you have used your own funds of 10 lakh rupee. Of course, you don't have to pay any interest, but the entire 2 lakh rupee is essential to get a return of equity of 20% on entire 10 lakh rupee capital. So that's the difference. So with a lower equity base, higher borrowing, your return on equity will always be higher. Whereas if you have a higher capital with no borrowings, then what happens is whatever you need to significantly earn more to match the percentage of return on equity. So another example of loan, borrowing and repayment. So how does the EMI work out? So let's say you have borrowed 5 lakh rupee at a 12% interest per annum for a 3-year period. So effectively your EMI will be around 16,607 per month, and you would have repaid around 5,97,000, which is basically 97,000 the interest cost. That is the additional cost for a period of 3 years, which is allowed as a expense for the income tax calculation. Okay, so hope I've been able to help you out to take a decision on whether loans have to be taken or not. For any business to be successful, it has to grow. It has to grow at a reasonable profit, but it need not be growing at your own capital. You can always borrow and repay with the money you are earning by investing that money on your business. So loans is actually a prudent thing to avail, but at the same time, the downside is too much borrowings is also not good for the business. So an ideal percentage would be like around 20 to 30% of own capital and around 60 to 70% of borrowing capital. Okay, so all the best for your businesses. Thank you.